Alrighty, happy Sunday. Hello, everyone. Good afternoon. Hope we're all doing well. Ready to get back to business here this week. We get a mic check here real quick. Alrighty, happy Sunday. Hello, everyone. Good afternoon. All right, guys, we're ready to go. Hope you guys are doing well. Happy Sunday. Glad to be here with you guys. Truth be told, was not really feeling up for a live stream today. Just so you guys know, on my end, it's 7 days a week, right? Sunday live stream, either live trading or trading every single day of the week with the mentorship group, my community. On Saturdays, that's when I'm usually attending to my one-on-one clients, and then Sundays here to do it all over again. So wasn't really feeling it here today, but since I do demand excellence from those I'm coaching, from those I'm working with, pushing them to higher levels to be consistent, be disciplined, and show up, the least I can do is show up here for you guys, even if I don't feel like it. So nonetheless, though, happy to be here with you guys. I'm excited to teach you guys some things here today. If you stay till the end, I will be going over a new trading model that you guys can apply using gap theory and how you guys can use these inefficiencies to frame very low risk, high probability trade setups. So I'm going to share a model. You guys are going to see me actually executing on it. And then I'll go into all the details that allows me to trust that trade and how you can start using it in the future. Since we're on the other side of February 7th, trading's going to pick up a bit more on my end. So I figured we'd get back to the lovely PowerPoints, keep things focused on point, and drive the analysis forward in a concise, straightforward way. So with that, guys, appreciate you all joining us here today. Cleo, happy Sunday. Kevin, happy Sunday. Hope you're doing good as well, Kevin. Joe, my man, hello. Essence CM, manage, let's fucking go. Glad to be here, guys. Glad to be here. Hey, hope you're well. Absolutely, doing phenomenal. Can't complain. Unicorn, James, Jeff, happy Sunday to all you guys. Alrighty, without any further ado then, let's get into the business. And then once I get through everything I have intended to share here with you guys today, I'll go ahead and get into some Q&A with you guys. You guys usually have some lovely questions for me, some markets you guys want me to take a look at. I'd be more than happy to do that with you guys. Abraham, happy Sunday, brother. Silver Bullet Trader, hello. All right, guys, let's go ahead and get into the business. You're a very polite man. Yeah, grandma always taught me you always got to be kind, right? All right, let's get into the business here today, guys. So weekly forecast for February 9th, 2025. So the economic calendar this week, two landmines, specifically Fed Chair Powell Tuesday and Wednesday. Generally, I stay clear when that's the case, or I'll engage pre-market, right? If I'm expecting a sloppy morning session, which is a general rule of thumb, if you don't have this written down, you want it written down somewhere. When the Fed is involved, stay out. That's something I've learned. It served me very well. So these two mornings, Tuesday and Wednesday, we have Fed Chair Powell speaking. So if I will be doing anything, it'll be on the other side of that, or either in the pre-market session before 9:30, anywhere from 7 to 9 o'clock. So I will be active Monday, Tuesday, and Friday, likely for my heaviest trading. But as always, that'll be covered in great detail in our weekly newsletter that my man Tommy writes up. And as always, it's going to be top notch. So with that, moving forward, we're going to get into the usual intermarket analysis, what I'm looking at for this week in the dollar, confirming that with treasury bonds, and then from there moving over to equities or index futures. Let's go ahead and get into the intermarket analysis here for this week. So starting with the US dollar here on the weekly time frame. So I'm staying with the underlying bullish order flow. If we break down through the weekly fair value gap on the daily time frame, right? So this weekly fair value gap is labeled on the weekly. But if we get a closure below it on the daily time frame, then I'll have to reassess my bullish stance, meaning I'll be either bearish to neutral. But as long as we remain above this key fair value gap in this down close candle, which is a bullish order block, as long as we remain above that, I'm still looking for higher prices. I've learned throughout my years of doing this, it's a loser's game to try to call in a top and bottom. So as long as we remain bullish on the weekly chart, I'm going to stay in line with that until the market decisively confirms it's bearish for my longer term perspective. Working down into the daily, I'm neutral on the daily chart for right now. If you look at this market structure here, a lot of wicks, a lot of wicking back and forth, pulling back into the range. So we are a bit sloppy on the daily chart, right? So right now I'm neutral, but I will read order flow at these key levels to measure if we're bullish or bearish on the daily time frame. So now, what does that even mean? Well, we have a daily fair value gap here above market price, and then we have this daily imbalance here that we've been finding support above, and also this daily breaker here, extending that through. So we've remained above that. So I've still remained bullish because of these factors here. However, I will have to gauge how we trade more specifically inside this purple fair value gap here. If we get above it, start to show strength through that, then I'll look for this wick here, midpoint, split that in half, and then we have these equal highs if we show strength through those key levels. But if the market gives me feedback that it's bearish in here, right, we start to rotate to the downside, break structure to the downside, start to show bearish order flow, then I'll look for these relatively equal lows here and this low down here if we accelerate through that. So again, when the market structure is sloppy, it seems a lot more like my analysis is calling both sides of the market. I'm not doing that. I have to see what information I get early in the week, and then from there, that'll allow me to pivot and then see what liquidity pools or inefficiencies I'll be targeting for the week. Moving right along into the hourly time frame. I'm watching how we trade again inside this purple daily fair value gap this week, this one right here. Make sure you guys can see that. Yeah, so we have an intermediate term low here below us. Why is that intermediate term low? Because this low ran out the sell side here, and this low here took out this sell side. So as of right now, we have this intermediate term low here, this one here above it. So starting to see bullish indication of bullish market structure. So as long as we remain above this intermediate term low, I'll be looking for higher prices. If we break this intermediate term low to the downside on the hourly chart, then again, I'll pivot and likely be looking for lower prices. So it'll be a lot of assessing what information we get early on in the week. All right, moving along into bonds. So looking at the monthly chart, might be a bit small here, but I hope you guys can see that. So monthly high likely priced in. So if we look at the monthly candle through power of 3, which is what I'm always looking at on all candlesticks, we opened the month here. We've traded higher. So if we are going to see open high, low, close, I do want to see this be the high of the month. If you look at this wick here that we traded into, which is a premium wick, just a wick above market price, we traded up into the midpoint, and then we quickly rejected that to the downside. So if this is the wick creation of the monthly candle, then I want to see heavy distribution and a breakdown to the downside, right? So from here, I will look for lower prices to continue this longer term downtrend that we find ourselves in on bonds. Moving into the weekly chart. So we got a nice rejection from the weekly fair value gap, creating a reversal candle, right? So dojis in and of themselves don't mean anything. But if you look for a doji in the right context, then it can help you frame reversals. So we see we traded up into this weekly imbalance here, right, reaching for a deep premium, and then a strong rejection of that there. So as long as we remain below the previous week's high, right, so this weekly candlestick here, as long as we remain below this candle's high here, I'm bearish on bonds looking for lower prices. Working down into the daily chart, so we see the market repricing to a premium market and rejecting aggressively, confirming bearishness. So we have this range high, this range low, that's our dealing range. The market's traded up into a premium, and now we're starting to see a strong rejection of the premium valuation. I want to see the most recent daily fair value gap, which is right here, act as an inversion fair value gap if we're to remain bearish, meaning we close down below it here. So now I want to see next week open, trade up into it, fail to get above it, and then start to melt lower and attack the external range liquidity, right? Internal range liquidity has been attacked. Now I want to see external here delivered to the downside if we're going to remain bearish on treasury bonds. And again, that's going to support a higher dollar, which is why I'm leaning bullish dollar because of what I'm seeing in the treasury markets, right? So dollar currencies are going to derive their value from the bond market, which is why bonds are very important to be including in your analysis, especially if you're a currency trader. If you're trading equity markets or index futures, then it's not as impactful, but it is still helpful in gauging risk on, risk off sentiment. So that's the business there for foreign currency. So before I even get asked about euro, pound, it's just going to be the inverse, right, of what I'm looking at in US dollar. All right, so weekly chart for NASDAQ. So neutral bias, spelled that wrong, little typo on my end. Neutral bias, same as last week, right? So if you look at the weekly range that we've been in, I did have a bias last week, and you can see why, because we still remain in the range, right? So, I mean, I guess the bias was looking for a consolidation profile, and we nailed it right on the head. But I don't have a clear bias in terms of where I can point to as to where I think this weekly candlestick is going, either higher or lower, right? So no clear market structure or order flow for me to have a clear higher time frame read. But again, just because I don't have a clear higher time frame read, that doesn't mean money isn't being made, right? Because we absolutely fucking banked last week, all banking through the past 2 to 3 months, easy money. Because just like I showed you guys in last Sunday's live stream, right? I didn't just leave you guys off with it's neutral, low probability. I taught you guys how to go in and find setups using your 15-minute chart, framing the intraday liquidity, and you have setups session after session after session, even in a sloppy consolidation where most are getting their asses handed to them. All right, moving right along into the daily chart. So again, neutral bias, same as last week. Market remains in a consolidation profile, emphasizing surgical strikes, right? And that's exactly what I taught you guys last week. So not just, again, leaving you guys off with low probability, actually teaching you guys how to go in and fish, which is understanding that the market's in a range. That doesn't mean there aren't setups. It just means you have to manage your expectations really well and frame intraday quick in and out. Because if you try to overstay your welcome, look for these massive trades, I've learned in these higher time frame consolidation profiles, they're more likely to fail you if you're not aligning your expectations with what the market is giving you. And moving along into the 4-hour chart, you can clearly see here consolidation profile, right? We have these equal highs here, equal lows. The market's not interested in breaking to the highs or the lows, and it keeps pulling back into the range equilibrium. So I was getting asked, how do you know it's a consolidation? Well, once we see the market fail to break this high here, right? It tried here, we broke back down, tried to break this low here, pulled back into the range. That's indicating it's not in an expansion profile. So when we see the market fail to attack external range liquidity, and it continues to pull back into equilibrium. What's equilibrium? We'll measure the high of the range, which is here. The low of the range, equilibrium is about here. The market trades up, stops short of the liquidity, trades back down into equilibrium, and we see that. And when you see that in price action, it's confirming to you that the market's in a consolidation profile. Now that's helpful for several reasons. One, it helps you manage expectations, right? Because if you're trying to look for these huge swing trades that take out the external range liquidity, you're likely going to get burned, especially if you're not taking partials on the way. Another thing that it helps us with is knowing what we're looking for, right? Like I shared with you guys last week, surgical strikes, right? In and out, and I even taught you guys how to find those liquidity pools. Also, you want to look for levels of fair value, right? New day opening gap, new week opening gap. The market's going to refer to these levels of fair value because if it's not expanding, it's consolidating. If it's consolidating, it's referring to very specific algorithmic reference points, which are known as fair value, which is where we closed the previous week, where we open the new week, where we close the previous day, and where we open the next day, right? That's your new day opening gap and your new week opening gap. So if you're using those reference points for targets, it's going to serve you very well in a consolidation profile. So with that, that's all I have here for dollar bonds and NASDAQ, breezing through that here pretty quickly. So let's go ahead and get into the money making stuff. I want to share some things with you guys with a trading model that you guys are able to use if you understand gap theory. Right, so what is gap theory? Let's get into the charts here. I'll show you guys real quick. So if you have an imbalance, right, it can be any imbalance, a fair value gap, a new week opening gap, a new day opening gap, a what's another form? A volume imbalance, right? Those are the four. Those are the four main gaps. So now how do you use these imbalances in your analysis or gap theory? Well, if we're bearish, right, and this is the example I'm going to use. I'm just going to go into one example. If I went through all four, then that would just basically be mentorship, right? So if we're bearish and we're above a gap, we want to see the market trade through it, use it as resistance, and sell off. Pretty simple concept. But now how do you use this to find setups? Let's get into the execution here, and then I'll break down all the details as to how I was able to frame this lovely trade here live with the concepts and the tools that I teach. So looking at NASDAQ here on Friday, as we trade up into that 15-second imbalance there, pulling the trigger on a short. So again, shorting inside this fair value gap here, right? Because the market should not get above that if we're bearish. And then the stop just goes above the fair value gap because I'm expecting this gap here to send price lower, right? Simple gap theory. And then again, what am I targeting? What did I teach you guys last week? Your 15-minute chart. Equal highs, equal lows. So very nice feedback here. Very nice feedback here that we're getting from this gap. Trades up into it, quickly leaves it. That's exactly what you want to see when you're trading a fair value gap. You don't want to see it spend a lot of time in it. This gap here becomes an inversion fair value gap, right? Because we don't want to see it use this gap as support, right? We want to see it trade down through it because the draw on liquidity is bearish, right? So it should get down through this gap, resistance, and sell off. So that's what I'm labeling there with the inversion fair value gap. All right, so just typing out here that we want to see speed through the low, because if the market is going to trade into those equal lows where my limit order's at, it's not going to want to give those traders a chance to move their stop loss. If you think about it, right, when you're in a trade and the market's trading towards your stop loss, what do you start doing? You immediately start thinking, oh shit, the closer it gets to my stop loss, the more likely it is going to hit it. So whenever there is a clear liquidity pool, as I showed you on that 15-minute chart, those equal lows, and that's actually the previous day's low, and the market's starting to get close to that, it's going to want to accelerate into those orders. Because those traders with stop losses there, they have the same psychology like we do. And the AI that delivers this price wants to get into those orders while they're still there and not give them time to pull it. So how am I able to predict that we want to see speed through this low? It's because I understand the AI is going to want to drive price into those orders, and it's going to accelerate through this low. And that's a signature I want to see when I'm in my trades. And then I'll get into the higher time frame as to what allowed me to frame that. So looking at the 15-minute gap here, or 5-minute gap, or on the 5-minute chart, this hourly gap, I'll show you guys what I'm looking at there. All right, so let's get into the business here and show you guys how I was able to frame that setup. So looking at NASDAQ here on Friday, we're trading at 930, which is right here, in close proximity to this gap here. So I'm going to extend this gap through for the entire day. Reason being is it's going to give me insight as to whether the market is bullish or bearish, right? So I'm watching this gap here. If we remain above it, the market's communicating strength. If we get below it, then that's giving me insight that the market is weak, right? Simple gap theory. So now you're going to see in the 5-minute time frame, as I was just showing on that example there, just doing market replay so we can see it cleaner here. Once the market breaks down through this gap, what's that telling me? Is the market bullish or is it bearish? It's probably not very bullish if we're breaking down through imbalances, right? Especially on a higher time frame. So now how do I use that to frame a setup? Well, number one, we have to know what the market's likely to draw to. And like I tell you guys on the 15-minute chart, if they're relatively equal, then it's even higher probability. But the way I was able to frame the setup was once the market broke down through that hourly gap and closed below it, very important, and then the market trades up into it, I'm going to allow it to do that. And then I want to see that next rejection. As soon as we reject that next lower time frame fair value gap, I'm in there going short, targeting the liquidity pool. So as we drop that into the 15-second, what do we have here? Now this chart, the execution takes on whole new meaning, right? The market trades up into the gap, and then we decisively break away from it. The next imbalance, I'm in there going short, and then just a surgical strike into the lows. And again, exactly what I shared with you guys last week, I already know how I'm going to make money the next week. And I told you guys it was going to be intraday surgical strikes using 15-minute liquidity pools. And that's exactly what I did this week, banking every single day that I'm trading live with the community, showing what I teach applied in action every single week, week after week, bringing receipts, right? So that's the setup here, going short in the fair value gap, stop above the high, because once we break away from that gap, we don't want to see it get back up to that. So that's why I'm entering there, stop loss here, targeting the losing trader stop losses or the previous day's low down here. So that's a supplement to gap theory, how you're able to use that to frame setups. So if you have an inversion fair value gap, right? Let's go ahead and go into another example here. So for those of you guys that want me to teach how to do the PM session, like I said, I've been really busy with what I'm doing with mentorship and what I've got working on there. So I haven't been able to do too much on the YouTube, but I've been getting a lot of questions on trading the PM session. Very straightforward. You want to use the lunch liquidity and you want to see what the lunch hour does. Lunch hour is 11:30 to 1:30. When we're expecting, well, let me go into the daily range here too. So at 9:30, they pump it higher, right? That's a Judas swing, and then it breaks down. If we're going to see the low of the day price in, which is from 3 to 4 o'clock, that's when I expect the higher low of the day to form, whether the day's bullish or bearish. In a bearish day, the low of the day will form from 3 to 4 o'clock. What that's implying is the PM session is going to be a continuation of the AM, right? Because if we're going to close near the low, then it makes sense that the PM session is going to be a continuation of the AM session. But what do we want to see before we get that PM session continuation? We want to see the market price higher into a premium in this lunch hour here. What this does is anyone that has a trailed stop, they're knocked out. And then what's the market going to target? Equal highs and equal lows. So here we have relatively equal lows that formed during the lunch hour here. Very important. So once the market breaks down, you can target these lows here. Very easy trading in the PM session if you know what you're looking for, but that's the key. You have to know what you're looking for. So now how can you use that concept of gap theory that I just taught you? Well, we have this gap here. Extend that through. Get a midpoint on there. I covered the draw and liquidity, right? That's going to be the most important. If you try to pattern trade this, it's not going to work. You have to know what the market's likely to draw to. Then when you have this as confirmation, it just makes it even higher probability. So we have a gap here. We're aiming for the lows. What's going to tell us the market's bearish here? Do we want to see the market hit this gap, use it as support and go higher? Not if we're bearish, right? It should close down below it, use it as resistance, and then provide a setup into the lows. So what's the logic? As soon as we hit that gap and then we displace, you want to short the next fair value gap. So let's go into a 5-second chart. And let's scrub back here. So again, we're aiming for the liquidity down here, right? That forms in the lunch hour. Now, how can you go about framing an entry, right? You can just short the inversion fair value gap as it's trading up into it, right? There's nothing wrong with just shorting that as it's trading up into it. But we want to see it do what? Trade up into it, reject it strongly. And if we stay in the lower half like we see here, even better. Market sharply breaks away. And the next fair value gap you want to short. And then what you're able to do with that is frame these beautiful risk to reward trades here. And then now, man, you're trading like the Instagram guys. So just wanted to show you guys another example of how it's used, right? I use it on the hourly chart, but it's again working in the PM session, right? So these models form all day, every day, right? And the better you get at reading price action, the more opportunities you're naturally going to have in the markets. And obviously there's hundreds of more entries I could go over here, but just for the sake of the model, I want to show you guys how you apply it and how you can use it in multiple different scenarios, right? Forms very consistently, and it even allows you to get better risk to reward because you're able to frame the entries on the lower time frame with higher time frame PD arrays. So hope that was insightful, guys. That's it for that teaching I wanted to share with you guys. Wanted to share another one there to supplement it. And I'll get into Q&A, any questions you guys have for me. Everything is clear. We have to unlock it. Absolutely. Absolutely, right? And how do you unlock that clarity in your understanding? Through study and repetition, right? Journaling, backtesting, doing the necessary work that it's going to require for you to be able to see things on the right edge of the chart, right? Because if you're uncertain when it comes time to take a trade, if you're anxious, if you're always having to wait for confirmation, it's a sign that you just haven't studied it enough yet, right? There's nothing wrong with that. It just means you have to invest more time into studying and really learning how to read price action. Because again, once you know how to read price action, it unlocks unlimited opportunities for you. Super insightful. Thanks a lot. Yeah, absolutely, guys. Appreciate the feedback. Instagram, guys. Yeah, it's a good one. That's so funny, man. I get traders that, and even unfortunately, some of my friends fell victim to this. Those Instagram guys with their 100R trades, and they're still trading micro lots, and they're doing 100R trades, right? So I gotta always take a dig at those guys. It's funny. Samad, thank you so much, Dylan. Very insightful. Absolutely, brother. Aslam, why avoiding the AM session when Powell speaks? Have you ever seen price action when Powell does speak? If it's something you haven't experienced or you may be new in the markets, whenever the Fed chair is speaking, it invites what's called manual intervention, which is where when the AI is in control of price, I'm able to run circles around these markets, as you can see. However, during periods of manual intervention, right? And what does that look like? We can see when the market's fluid like this, it's very easy trading, right? This PM session, very easy trading. An example of manual intervention would be, let's go to Thursday before non-farm payroll. This is manual intervention, right? Where the AI is not in control of delivering price. It's where it's much more likely to be manipulated. The folks that control the market, go in there and they're manually twisting dials, making the market go wherever they want it to go. When that's the case, this is the type of price delivery you get. I want to avoid this at all costs. One of the testaments of being a good trader is knowing what conditions your models perform best and knowing what conditions your models perform the worst. I have no shame in admitting in this type of price action here, it would look like romper room. It would not look like the $1 million trading you guys are used to seeing from me, because I know when to push my edge and I know when it's not likely to be effective, right? So this is an example of what manual intervention looks like. And if you've ever studied, like, go back, actually back test this, take the time to investigate this yourself. Don't just rely on what I'm saying. Look at the days when the Fed chair is scheduled to speak and look at the price delivery an hour before it and about an hour after, and you'll see a lot more of this right here. So now you tell me, if you can avoid this and focus on this type of price action, you do that every day of the week, right? And that's what I'm sharing with you guys that I'm doing in my trading. Hopefully that makes sense, Aslam. Great question. Update on the mentorship. Appreciate the reminder. Absolutely. So everything's moving forward very nicely on that. The wait list will be uploaded to the Discord for the free Discord once you guys will be able to have the first opportunity. As you guys know, we're only limited to 3 new spots a week because, again, for you to get enrolled, you do have to speak with me one-on-one for about a 45-minute action plan session. We're able to discuss, again, where you're at, what your goals are with trading, right? What are you even in this for? And then give you a solid game plan as to how you're going to get there. And my time is limited to 3 per week. So if you get on the wait list, the sooner you get on. If you want to get to work, if you want to start getting results right away, I recommend the sooner the better, because if you get backlogged on the wait list, then who knows how long you'll have to wait to schedule your session to speak with me before you can even sign up, right? So that's where we're at with that. That will be announced on the free Discord for those of you guys that are interested in getting to work with myself, my team, and us getting you to where you're at or where you're looking to go with your trading. Alessandro, any specific CPI protocol? Nothing really. It's not like a non-farm payroll protocol week. Generally, what I've learned is days before high impact news can be a little difficult, but you just have to manage it well. Never enter before, and after CPI, I have no problem trading about 30 minutes after. However, since we have Fed Chair Powell speaking directly after CPI, that throws a bit of a wrench in my trading for that day. So I probably won't be too active that day. Again, there's just cleaner days to trade in my opinion, and it could be beautiful, right? And I'm okay missing those days, right? Just like that Thursday I just showed you guys, that was pretty crappy. Most of the time, the day before an off-farm payroll is going to look like that. Some days, once in a blue moon, it will be clean, but I never regret not trading or avoiding those days. What's my thoughts on crypto? I'll go ahead and take a look at Bitcoin for you guys. Take a look at BTC. Yeah, in my opinion, I'm still looking for lower prices on Bitcoin. I like these equal lows here. As long as we remain below the body of this up close here. See how we tried to work into that here, tried to work into it once more, slam lower, and we're staying below this up close candle here. So as long as we remain below that, my next target will be the midpoint of this wick here, which will take us into 94,400. And then if we accelerate through midpoint of that wick there, then we have the sell side here at 91K and then at 89 down here. Looking at Ethereum, hey, you guys remember last week, right? I gave you guys the equal lows here on the market maker sell model, right? The original consolidation. Haven't looked at Ethereum. Looks like they cleaned out that sell side down here. So nice targets delivered on Ethereum here. I'm still seeing weakness on Ethereum here as well. Much weaker than Bitcoin. If you guys recall last week, I gave you guys the SMT that helped with my analysis, right? Again, SMT by itself doesn't mean a whole lot. In proper context, it is very helpful though. So here with Bitcoin, we ran out this high. NASDAQ, so you can trading index futures. Ethereum failed to make a higher high here, and that's the SMT divergence, indicating Ethereum, like I said last week, is under heavy accumulation of shorts. Right, and you can see it delivered much better to the downside. Right, still some downside on Bitcoin, right, but not as nice of a flush as we got on on Ethereum here, right? And that's understanding SMT and how all those factors nest together. But as long as you remain below this gap here, I want to see that act as a breakaway gap, send price lower on Ethereum. Next draw would be the midpoint of this wick here. Call that 2,500. And then if we accelerate through that, then we have these equal lows down here. If you had to put it in a checklist, how would the model look like? I'm trying to think how I want to answer that. So you can take what I've shared there and crystallize it into your own checklist. But for me, I mean, to make it straightforward, you need to have a draw on liquidity, right? That's always going to be number one. For any model to work, you need to have a draw. Where's the market drawing to? Once that happens, you then want to confirm it with institutional order flow. The model has a built-in way of confirming order flow, right? Like for example, that hourly gap was closed below. That's telling you we're bearish. Same thing when I showed you on that PM session example. We closed below that 1 minute gap, indicating it's bearish. So first thing is the draw on liquidity. Confirm the draw on liquidity with order flow. Let the market trade up into the gap, reject it, and then you're shorting the next lower time frame fair value gap for a simple step model. So you can just call it that. Do you know the mysterious IMP24 by ICT? No, don't know too much about it. From what I've heard from the man himself, he shared it's his personal algorithm, how he relates to the price engine that actually delivers price, and it helps him map out the high and the low of the day. So seems pretty cool, but he says he's not willing to share it, and what he has shared is more than enough to make a shitload of money. So personally, I'm not too worried about it. Looking forward to it. Thank you. Absolutely, Cleo. James, do you include seasonal tendency? Absolutely, yeah. Seasonal tendencies is something I very much so use for my macro perspective and macro analysis. Absolutely. Can you take a look at Solana? Yeah, let's take a look at Solana. Man, this is turning into the crypto show. Sol USDT. Let's go into Binance. Yeah, so I'd watch the same thing here on Solana. We have this up close candle here because there's a large wick here. Use the body. As long as you remain below that, looking for lower prices here, these relatively equal lows. And if we accelerate through that, we have these lows down here. If we get above this up close candle, then that'll change things for me on the short term. Manage, thanks, bro. I thought so, but I wanted to hear it from you. Yeah, good question, man. Good question. A lot of new things, right? Always new shiny objects in the industry, right? The key is to find what works for you, master it, and that's all you need to unlock the ATM machine of the markets. Musa, thank you. Absolutely. Alessandro, thanks, sir. Always a pleasure. Absolutely. Glad to have you guys here. All right, guys. See the questions slowing down. Do you guys have anything else for me before I get going here? Going into the week with managed expectations? Yes, sir. Yes, sir. What is the mentorship cost for 2025? The investment and all those details are going to be on the page that we'll upload for you guys to go access, and you can get access to all that information there if it's something that you're interested in investing in yourself and your trading, right? Not for everybody, but just for those that are motivated, are hardworking, and want to make an income stream from the markets, right? Outside of those three things, we can't help you, and we're not able to really deliver results for you. But if you're hardworking, if you do want to make an income stream from the markets and you're serious about it, you're serious about working with professionals that are wanting to guide you there, then we're more than happy to take you in if you qualify and work with you guys. Alrighty, folks. That should be it for today then. Appreciate you all joining us here. Hope you guys have a lovely rest of your weekend, and I'll see you guys on the next one. Take care, everyone. See you guys.